Survival Tactics for 2026. Before we enter the decisive moment, let's conduct a thought experiment. Fast forward to the end of 2026. The difference between investment winners and losers will not depend on who was more aggressive, but on who built the right defensive fortifications at the end of 2025. To survive and profit in this cycle rotation, we need to start directly with the conclusion. This is the barbell strategy allocation model I am recommending to institutional clients during this critical window. It is a 40-40-20 asset allocation structure designed to handle the impending spike in volatility. First, 40% of the position must be defensive. We need to build a dividend moat. The logic is simple. In the early stages of a rate-cutting cycle, an economic slowdown is a high-probability event. Regardless of how violently tech growth stocks correct, basic living needs are rigid. Therefore, capital should flow into utilities, consumer staples, and big pharma. These assets possess stable free cash flow and high dividend yields. In this portfolio, they act as bond-like stabilizers. The goal is not to double the stock price, but to ensure you beat inflation and, more importantly, avoid drawdowns. Second, the next 40% belongs to the offensive side, aiming to precisely snipe the new cycle alpha. This requires us to completely abandon the lazy thinking of buying the broad index. Capital must be withdrawn from the crowded tech giants and injected into valuation depressions that directly benefit from rate cuts and hard tech. Here, there are two core targets. 1. The Russell 2000 Index. As the main recipient of the Great Rotation, rate cuts will directly improve the balance sheets of small-cap stocks, bringing about a Davis double play of valuation repair. 2. Energy infrastructure and edge AI chips. As we will analyze later, these are the true winners of the second half of the AI game. The operating principle is very clear. Scale into positions, buy on pullbacks during market panic, and do not chase highs. Finally, the remaining 20% is the hedge. This is your insurance and dry powder. Never go all in. Of this, 10% is allocated to gold or hard assets. This is a hedge against the US dollar credit system. If Fed rate cuts lead to a 1972nd style resurgence of inflation, gold will be the only asset that protects purchasing power. The remaining 10% must be cash USD, T-bills. A black swan-style liquidity shock is inevitable in 2026, when the vast majority of market participants are panic selling because they are fully invested and trapped. This cash will be your only ammunition to loot premium assets at floor prices. This strategy is not pulled out of thin air. It is based on a profound understanding of the watershed moment of December 2025. Investing is not just a game of speed. It is a marathon of survival. So, why must we make such drastic position adjustments at this specific point in time? To answer this, we need to pull the timeline back to the present and dissect the core variable that is about to pull the trigger. Misread signals. The Federal Reserve announced a reduction in interest rates. According to futures market pricing, Wall Street's expectation for this has reached near 100% certainty. However, most retail investors are making a textbook linear thinking error. Rate cuts mean lower cost of capital, therefore stocks go up. If you are preparing to enter the market based on this logic, you are standing on the edge of a cliff. We need to correct this fatal cognitive bias. You must understand the underlying behavioral pattern of the Fed. They are not wealth managers. They are emergency room doctors for the economy. A healthy economy does not need potent painkillers. When Powell announces, "We need to lower rates," the subtext through the central bank jargon is, "The patient's vital signs are deteriorating. We must transfuse blood immediately to prevent shock." This is not alarmism. The macro data at the end of 2025 reveals the cold truth. The labor market has cracked. While the unemployment rate hasn't skyrocketed yet, full-time jobs are bleeding out, with new gains concentrated in low-wage, part-time work. This is a classic leading indicator of recession. Consumer balance sheets are deteriorating. The excess savings accumulated during the pandemic hit zero in Q3 2025. Current consumption relies heavily on credit card debt, and delinquency rates are rising. The corporate side is even grimmer, with small and medium enterprise bankruptcies hitting a 10-year high. Therefore, the upcoming rate cut is not a victory feast for prosperity. It is the start of a rescue operation. Historical data provides irrefutable evidence. Looking back at the three major rate cut cycles in 2000, 2007, and 2019, you find a startling pattern. The moment the Fed cuts rates for the first time is often not the market bottom, but the market top or the last dead cat bounce before a crash. The reason is that the rate cut itself is official confirmation of an economic downturn. From that moment on, the market's trading logic switches instantly from the inflation trade to the recession trade. All eyes will no longer be on how much rates drop, but will panic over how badly corporate earnings will deteriorate. This is the classic buy the rumor, sell the news. Furthermore, we cannot ignore the long and variable lags of monetary policy. Even if the Fed starts cutting rates at the end of 2025, the real economy will still be paying the debt for the high interest rate environment of 2023 to 2024 throughout the coming year. By 2026, a massive volume of corporate bonds issued years ago will face maturity. Companies must refinance. Even if rates are lowered, the new cost of capital will still be far higher than the zero-interest era. This means corporate financial burdens will not lighten in 2026. They will get heavier. This lag effect will act like an invisible noose, tightening around the throats of pseudo-tech stocks that lack positive cash flow. This explains why easy mode is about to end completely. As the rate cut cycle begins, capital flows will undergo a massive shift. In the past high-rate era, $6 trillion sat comfortably in money market funds, enjoying a risk-free 5% yield. But as the cycle kicks off on December 10th, risk-free yields will drop, and this massive capital will be forced out. Where will it go? It won't flow to overvalued tech giants. It will flow to depressions sensitive to borrowing costs. This is exactly where institutional money is betting. Small caps in the Russell 2000 typically carry high floating rate debt. Rate cuts are direct debt relief for them. Mathematically, this is called high convexity. Every 25 basis point cut could rebound their net profits by 10%. The biotech sector, an industry extremely dependent on R&D financing, will welcome an M&A frenzy once capital costs fall. Real estate and utilities, as typical bond substitutes, will see their dividend yields become extremely attractive as Treasury yields fall. At the same time, we must watch the US dollar index. As the Fed cuts rates, the dollar will enter a depreciation channel. For investors holding only USD assets, this means shrinking purchasing power. But for global allocators, this is a huge opportunity. A weak dollar usually means commodities priced in dollars, like gold, copper, crude oil, rise, and capital flows back into emerging markets. Structural fracture. Reviewing the market truth of 2025. Having understood the future strategy and the current trigger point, we need the final piece of the puzzle. Why was the market performance of the past year so deceptive? This requires us to tear off the grand narrative and see the true structure of the 2025 market. Over the past year, U.S. stocks have shown an extremely rare bifurcated form. If you view the S&P 500 index as a single company, its internal organizational structure is completely unbalanced. Data shows that in the past 12 months, the vast majority of the index's gains came from just those 6 to 7 tech giants. Their trillion-dollar market cap weightings distorted the index's performance. As long as they rise 1%, they can mask the fact that the other 490-plus companies fell by 1%. It's like sitting in a room with Elon Musk and 499 ordinary workers. When calculating average wealth, everyone is a billionaire, but that doesn't change the reality that the 499 people are facing mortgage pressure. The current U.S. stock market is exactly this room. You feel torn because your life exists in the real economy, represented by the remaining 493 companies, while the index lives in a capital bubble woven by the giants. This split reached its peak in 2025. Massive numbers of small-cap stocks, traditional manufacturing, and even consumer stocks have actually already experienced a stealth bear market. The root of this distortion lies in the side effects of passive investing. Looking back at 2023 to 2025, we experienced a rare, easy mode in investment history. The core logic was liquidity flood superimposed on a single AI narrative. The mechanism of ETFs exacerbated this cycle. Funds buy mechanically according to weight, causing large companies to receive more capital, their stock prices to rise, their market caps to grow larger, and their weights to become higher. This is a self-reinforcing positive feedback loop. But by the end of 2025, the laws of physics are starting to take effect. Valuation has gravity. When the price-to-earnings PE ratio overdraws the next 10 years of performance, any macro breeze can instantly reverse the positive loop into a reverse stampede. Right now, the mindless buying power of ETFs is exhausted. Retail liquidity has dried up due to inflation. Once passive buying stalls, the market will return to the most primitive pricing logic: true profitability and value. This means the strategy of closing your eyes and buying giants will not only fail in 2026, but will become an asset killer. This also explains why we must be wary of separating the wheat from the chaff in the AI race. A vast number of AI application companies that emerged in the past 2 years are essentially just wrappers, calling an API interface to make a web page. By 2026, as the capabilities of large models become generalized, for example, operating systems directly integrating PDF analysis functions, the value of these middlemen will instantly hit zero. Similarly, traditional SaaS companies that rely on charging per seat will face a crisis, because the core of AI is efficiency improvement and cost reduction, reducing headcount. Conversely, capital logic is shifting from training to inference. For the past 3 years, NVIDIA was the king of selling shovels. But at the end of 2025, the focus will shift to making AI run in practical applications. This means hardware demand will shift from extreme high performance to cost-effective mass adoption. Capital will frantically chase those companies that possess exclusive private data and can train vertical domain agents. Back to our starting point. December 2025 is not just a month on the calendar. It is a geological fault line of the era. Over the past 3 years, luck has often masked strategic laziness. But in the coming 2026, the market will brutally punish those blind followers who lack logic and reward the few who understand the macro trends and execute their allocation with discipline. Top fund managers on Wall Street are conducting a great reallocation of historic proportions. They haven't liquidated, but they are rapidly deleveraging and de-risking, moving capital from crowded tracks to forgotten corners. This is not just a position adjustment, it is an advanced bet on the macro upheaval of 2026. Now, what you need to do is take your eyes off the noisy news headlines and focus on these core variables that truly determine the market's direction. Don't cheer for the interest rate cut. Instead, listen to the sound of the starting gun behind it. Maintain independent thinking and stick to your trading discipline.